All right, deep breath. If you're new here, I'm the Asian guy. I've been around enough charts, trading desks, and too big to talk about deals to know one thing. The market doesn't move on vibes. It moves on pressure, and on the stuff most people never see. Now look, today is the day we do some analysis. Because yesterday felt like the end of the world. We watched silver plunge from an all-time high of $8,362 down into a terrifying free fall that wiped out billions of dollars in paper wealth in a matter of hours. Sentiment flipped from euphoria to panic faster than an algorithm can execute a sell order. Bears came out of hibernation. Mainstream media started writing obituaries for the silver bull run. And I know a lot of you were glued to your screens, finger hovering over the sell button, wondering if the dream was over. But today the sun came up, the markets opened, and something very specific, very technical, very important happened. The bleeding stopped. Ignore the noise. Ignore the headlines screaming volatility. I want you to lock in on one single number that flashed on the screen today. $75.32. That was the low of the day. That was the exact price point where selling pressure exhausted itself, and buyers stepped back in with a vengeance. And I'm telling you right now, 75.32 is not random. It's not coincidence. It's a mathematical line in the sand drawn by the smartest money in the room. What we're witnessing isn't a crash continuing into oblivion. It's a textbook technical defense of a critical support level. We're watching the formation of a floor, and understanding why this floor formed at basically $75 is the key to understanding what happens next. Go back to the history of this rally, November and early December of 2025. Where did we spend weeks consolidating? Where did the massive volume clusters occur before we broke out to $80? We fought in the $75 range for weeks. Back then, $75 was the ceiling, resistance. Every time price tried to break it, sellers shoved it back down. But in technical analysis, there's a golden rule. Previous resistance becomes new support. That's the polarity principle. You break through a ceiling, that ceiling becomes the floor you stand on. And that is exactly what happened today. Price retraced all the way back to the scene of the breakout, tested the structural integrity of that level. And it held. It held firm. That tells us the smart money, the institutional allocators, the industrial hedgers, the deep pocket whales, were waiting right there. They didn't chase at $83 yesterday. They waited. They set their limit orders at $75.30 and let panicked retail traders sell straight into their hands. And this is where the market's darker little secret shows up. The market loves to embarrass the crowd. The weak hands, the people who bought the top from pure FOMO, got flushed. They panic sold when they saw red. But the strong hands, the entities that actually need physical silver for solar panels and electronics, looked at $75 and saw a discount. They stepped in and built a wall. And it's not just price memory, it's volume. If you look at the volume profile over the last 2 months, the thickest cluster of trading activity is right around $75. That means there's a massive amount of vested interest at that level. Millions of contracts were bought there. Those buyers are defending their positions. They're not going to let price slip below their average entry without a fight. So while the uneducated trader sees a drop from $83 to $75 and screams crash, the professional sees a drop to $75.32 and says, retest. A retest is healthy. A retest confirms the breakout was real. A retest builds the foundation for the next leg higher. We're not looking at a dead cat bounce. We're looking at a market shaking off leverage, finding its footing, and proving the bull structure is intact. The floor is in. The panic is over. Now, let's talk about the machinery underneath all this, because the machines are trading this level as aggressively as humans. We identified the floor at 75.32 ounce. We identified the psychology, resistance becoming support. But if you want to know why this number held with such ferocity, you have to look through the eyes of the entities that actually control the day-to-day price action. I'm not talking about retail traders. I'm not talking about gold bugs on Twitter. I'm talking about the algorithms. In the modern financial ecosystem, roughly 70% of trades can be executed by machines. These machines don't feel fear. They don't feel greed. They don't care about geopolitical headlines or what the Fed chair had for breakfast. They care about math. They care about hard-coded coordinates that trigger billions of dollars in automatic orders. And today, silver tagged a coordinate so perfect it's almost suspicious. Let's talk Fibonacci retracement. Yeah, I know some of you roll your eyes like it's tea leaves, but here's the twist. Even if you don't believe in it, the machines do, because the machines are programmed to respect the golden ratio. If you draw a line from the absolute bottom of the rally in early November to the absolute top yesterday at $8,362, you get a series of retracement levels where corrections statistically tend to stop. The first shallow aggressive support is the 23.6% retracement. Do you know what that exact price is? $74.80. Now look at today's low, $75.32. We came within 50 of the 23.6% line and bounced. That tells you something brutal and beautiful about the health of this market. In a weak bull market, price usually corrects deeper, 38.2% or 50%, because it needs to go lower to find buyers. It needs to offer a bigger discount to drag money back in. But in a hyper-bullish market, overwhelming demand, non-existent supply, price barely corrects at all. Buyers are so hungry they step in at the first mathematical opportunity. They front-run the deeper correction. Holding the 23.6% level is dominance. It's the market saying, the dip is not allowed to go deeper. Algorithms calculated 74 to 80 cents as a fair, shallow pullback, and humans were so terrified of missing out that they bought above it at $75.32. They didn't even let it touch the line. They front-ran the robot. That is strength. And there's another line telling the same story, the 20-day moving average. Right now, it sits at 73.50. 50s. That line is the average price paid over the last month. In a normal correction, price often touches it to revert to the mean. Healthy reset. But today, we didn't touch it. We didn't even get close. We bottomed nearly $2 above the 20-day average. That's called front-running the mean. It happens when institutional capital is chasing the asset. Picture this. You're a fund manager at BlackRock or Vanguard. You've got a mandate to allocate $500 million into silver because your analysts won't shut up about the solar shortage. You missed the move to $83. You're praying for a pullback. Price starts dumping, 80, 78. You're staring at 76. Your model says fair value mean is $73.50. Do you wait for $73.50? No, because you know everyone else is waiting for $73.50. You know if you wait for perfect, you might get nothing. So you pay a premium. You park your order at $75. You pay about $2 over spot just to guarantee execution. That's what we saw today. Billions deciding paying a premium above average is better than missing the boat. That creates a dynamic floor. The floor isn't static. It's rising. Buyers step up the ladder and meet sellers higher and higher. That tells you the trend isn't just intact. It's accelerating. Now the most compelling evidence for the $75 floor isn't just where price stopped. It's volume. Price is the car. Volume is the gas. You can't fake volume. Look at the last 2 months and you'll see a massive bulge around $75, a high-volume node. Back in late November and early December, silver churned there for weeks while breaking out of the 60s. Millions of contracts changed hands, and every one of those contracts is a memory. Think about the trader who bought $75 in November. When price hit $83 yesterday, He felt like a genius. But when price dropped back to $75 today, he wasn't scared. He was basically break even. Now think about the guy who sold at $75 in November. The bear. The short who got squeezed for weeks watching price rip to $83. He was suffering, praying for a chance to escape without losing his shirt. Today, the market handed him a gift, back to his entry. So what does he do? He buys to cover. That's the double layer of buy pressure. Bulls defending entry, bears covering mistakes. Both sides buying at $75. That turns the level into a liquidity sponge. You could throw $1 billion of sell orders at $75 and it soaks it up. So when technical analysts say previous resistance becomes new support, it's not magic. It's mechanics, regret, and relief. Sellers regretting they sold at $75, buying back to relieve pain. Buyers regretting they didn't buy enough at $75, doubling down to relieve FOMO. That's accumulation. And we have to talk about the November outage spike. Remember November 11th? The day the CME had that glitch? Silver spiked to $56 and then crashed, only to rip higher later. That $56 level was the old floor. Now $75 is the new 56. Structure shifted up a gear. We graduated. We're not trading industrial commodity range anymore. We're trading monetary metal range. And the fact we flushed 14% in 24 hours and still held $75. That's the most bullish signal of the entire year. Weak market would have lost $75, tested 70, collapsed to 68. We defended the line. So when you combine the 23, 6% fib, the front running of the 20-day, and the volume sponge at $75, you get a structural fortress. Not wood, concrete and rebar. Algorithms know it. Institutional desks know it. And now you know it. But knowing the floor is there is only half the battle. The other half is spotting recovery signals, how we know sellers are truly exhausted. So open your daily chart, not the 5-minute noise. Look at what formed. A hammer candle. We opened under pressure. Sellers shoved price down to 75 and 32, trying to break the floor, induce panic, trigger a cascade. Then something snapped. Buyers stepped in, absorbed every sell order, and pushed price back up. That leaves the long lower shadow, small body near the highs. That hammer tells one story: rejection. The market rejected lower prices. It went down to look for value, found it, and bought it aggressively. A hammer at key support, especially right on that 23.6% zone, is the death nail for bears. Now, check the RSI. Yesterday, people screamed, overbought, needs to reset. Did RSI crash to 30? Oversold? No. It bounced off 65. That's massive. Weak markets reset down to 40 or 30. In a supercycle, the asset can live overbought for months. Bouncing at 65 means underlying strength. It's a bullish range shift. RSI isn't oscillating 30 to 70 anymore. It's oscillating 60-90. Momentum floor shifted up. So $75 isn't just a price floor, it's a momentum floor. The market refuses to cool off. And finally, volume again. Yesterday, sell volume was high. Panic. Today, as price dipped to $75, volume dried up. Volume exhaustion. At $75, nobody left to sell. Weak hands already puked. Then, as price recovered, volume rose on the buy side. That's the footprint of smart money accumulation. Institutions letting the selling die, then scooping quietly so they can fill. Hammer rejecting lows. RSI holding bullish territory at 65. Volume exhaustion, then buy volume returning. That setup screams buy. Yesterday's damage got repaired in one session. But technicals only tell you where price stopped, not who stopped it. So let's follow the money. Mainstream financial news will tell you silver is in turmoil and investors are fleeing volatility. But we don't listen to narratives. We look at flow data. Yesterday, Monday, we saw outflows, retail panic, weak hands puking positions at the lows. But today, tide turned. Net positive inflows into major silver ETFs. Big funds didn't sell the breakdown. They used it as a liquidity event to fill. When price stabilizes at $75 while ETF holdings rise, that divergence screams accumulation. Ownership transfers from nervous to confident, from leveraged speculator to long-term allocator. But paper market is only half the story. The real defense came from the physical market. We've got reports from commercial desks that industrial buyers, the companies consuming silver for solar panels, electronics, batteries, have been sitting on massive buy orders in the $75 to $76 range. A solar manufacturer doesn't care about your RSI. They care about inventory. Price ran to $83. They got priced out, stepped back, let speculators play. The moment price dropped back below $76, they pulled the trigger. That's the industrial put. Whenever price drops to where it makes economic sense to restock, factories buy everything in sight. Speculators run away on drops. Industrial users run toward drops. And there's another group you have to watch: commercial hedgers, bullion banks, and producers who usually hedge inventory by shorting. Historically, they're the shorts. But today, open interest is stabilizing, not spiking with aggressive new shorts. We're seeing signs commercials are covering some shorts, reducing risk into the dip. Ask yourself, why would a bank cover shorts at $75 if they thought price was going to $50? They wouldn't. They cover because downside is limited. They respect the trend. And when smart money stops shorting and starts covering, it often clears the runway for the next leg up. So put it together. ETF inflows, investment money returning, industrial giants stepping in under $76, physical demand rock solid, commercials covering, less appetite to bet against this floor. Triple confirmation, not just a technical bounce, a fundamental rejection of lower prices by every major class of buyer. Now we look forward, because markets don't move in straight lines. We've got obstacles. We've got the Fed minutes coming out. We've got the dollar index threatening to break out. The roadmap to $90 runs through targets like $78, $82, and beyond. But there's one risk factor that can still threaten this recovery. And to truly trust this $75 floor, you've got to understand the invisible forces holding it up. 3 pillars. Pillar 1, round number psychology. Humans love clean numbers: 25, 50, 75, 100. For 2 months, $75 was the line in the sand, the breakout level the entire street watched. Once we smashed through in early December, it was euphoria. Silver graduated. Now that we crashed back, $75 is the defense line. Hold it, and the story stays. Silver is a $75 asset heading to 100. Lose it, and the story flips. Fake breakout heading back to 50. Today's defense wasn't just protecting price, it was protecting the narrative. Pillar 2, the priced-in phenomenon regarding China. Everyone's terrified of the January 1st export licenses. Bears use it like a weapon. Maybe it won't happen. Maybe liquidity dries up. Whatever. But look where we are. Today is December 30th. Deadline is known. Fear has been digested. Yesterday's crash was the market pricing worst case. Here's the secret. Crashes usually happen before the event, not during. By dropping to $75, the market discounted the risk. It already took the hit. So now at $75, the China risk stops being a headwind and becomes a tailwind, because any strict confirmation, any shortage report becomes upside fuel. The downside is exhausted. Bad news is already in the price. Sellers scared of January 1st already sold. Who's left? The people who think January 1st starts a squeeze. You can't scare the market with the same story twice. Shock value is gone. Price stabilizes. Pillar 3, the industrial value proposition. And it's the hardest floor of all. Imagine the just-in-time supply chain manager at Samsung or Tesla. They don't speculate. They run factories. If they run out of silver, the assembly line stops. That costs millions per hour. For them, price is secondary to availability. Silver ran to $83. They got nervous, held back orders, sweating inventory. When silver crashed to $75 yesterday, they didn't panic. They celebrated. They saw a brief window to restock before the January 1st curtain falls. They know in 48 hours the rules change. They know getting metal out of China could turn into a bureaucratic nightmare. So $75 becomes the panic buy level for industry. Panic buying, not panic selling. That industrial bid is inelastic. Speculators change minds. Algorithms get reprogrammed. A factory can't run without raw materials. That demand doesn't disappear. So we've got the psychological fortress, priced in event, industrial safety net. That explains why the crash stopped dead. But, and this is a big but, we are not out of the woods. I'd be lying if I told you the path to $90 is clear. It isn't. There are landmines ahead that can crack $75 and send us tumbling to the next support cluster around $70. Biggest landmine is ticking down to this afternoon. Federal Reserve minutes. Today is Tuesday. Later this afternoon, the Fed drops minutes from their last meeting. Why it matters? Silver is priced in dollars, and the Fed controls the value of the dollar. The market is on edge. If the minutes come out hawkish, worried about inflation, hinting rates stay higher for longer or even go up again, it's lighting a match in a gas station. A hawkish surprise can send the US dollar ripping higher, and when the dollar spikes, silver usually drops. Seesaw, dollar up, commodities down. If algorithms read those minutes and decide dollar strength trade, they'll dump silver futures instantly. They won't care about the hammer. They won't care about industrial demand. They'll run the correlation trade. We could see a sudden violent test of $75 the moment minutes hit, maybe even a fake-out spike to $74 just to run stops. Be ready for that. That volatility would have nothing to do with silver and everything to do with the dollar. And speaking of the dollar, watch the DXY. It's hovering near dangerous levels, flirting with 110. If DXY breaks above 110, it's a wrecking ball for global markets. Super strong dollar sucks liquidity out, makes commodities expensive for emerging markets, pressures gold and silver. Right now, silver's trying to rally despite a strong dollar. That's strength. Usually silver collapses when the dollar is this high. The fact we're holding $75 with DXY at 109 is a miracle. But if DXY punches through 110, pressure might become too much. Dam might crack. Watch currency markets like a hawk. And finally, China policy risk. We're assuming January 1st export licenses are strict. Basically, a ban. But what if details come out soft? What if China issues a ton of export quotas? What if supply constraint isn't as bad as we thought? That would be deflationary for silver. Shanghai premium could collapse. Arbitrage closes, not by New York going up, but by Shanghai coming down. That's the black swan nobody wants to talk about. Everyone is positioned for shortage. If shortage turns into bureaucratic nothing burger, $70 floor can give way, can give. I don't believe it will happen. Geopolitics suggests China wants to weaponize resources, not share them. But as a risk manager, you acknowledge the possibility. So here's the reality. We've got a solid technical floor at $75, massive buying interest, bullish setup, but we're standing on a trap door. Fed minutes, dollar strength, China details, 3 latches holding it shut. If one snaps this afternoon, we could see one final flush, maybe even a nasty drop to $72 or $70 before the real recovery. However, if we survive this afternoon, if Fed minutes are neutral, if the dollar stays below 110, then the path of least resistance is higher, much higher. Because once those immediate risks clear, there's nothing left holding the beach ball underwater. Industrial demand takes over. Technical buyers chase momentum, and $75 stops being a floor and becomes a launch pad for the next leg of the bull run. So what are the targets? If $75 holds through the Fed noise today, where are we going tomorrow? Back to $80, straight to $90. In the final part of this update, I'm mapping the recovery targets with the measured move that points to a retest of the highs sooner than anyone expects. And I'll leave you with one key message. Learn the difference between a correction and a crash, because the market's favorite trick is shaking you out right before it rips. If you want that roadmap, $78, $82, the path to $90, and how to survive the stop hunts without becoming exit liquidity, then do me a favor. Hit like, subscribe, and drop a comment saying $75 floor, so I know you're watching the levels, not the headlines.